Are all startups valued equally? And what really drives higher valuations in one startup versus the other? Hi, my name is Rishab Malik. I was previously co-founder of Dealroom.in, an online automobile marketplace that recently became a unicorn. I'm an angel investor in a few dozen startups. I sit on the board of 6 to 7 early to growth stage companies. I'm currently a venture partner at Jungle Ventures, and today we're going to talk about valuations. Let me introduce you to a few factors that play an important role in determining this number. The first factors that investors focus on is the TAM, or the size of the total addressable market that your business is operating in. Typically, if your TAM is greater than $1 billion, it means that the business has enough room to grow. If the sector you're operating in is seeing increasing interest, you will see more capital flowing in there and increased investor and buyer interest. Finally, your relative position in that large market matters. If you are one of the top players in a large market, you will court multiple interested parties in contrast to if you are a lower tier of your market. In other words, avoid approaching investors with just a good idea. It should be a good idea plus sufficient proof, a big enough group of people who can benefit from it, a large market size, that the idea will eventually turn into a visible business opportunity. And that's where the total market size, TAM, or total addressable market comes in. The second factor that plays a very, very important role in startup valuations and funding is the team capabilities. Your ability to execute. Teams who can execute and have the experience and know-how of the market they're going to operate in will get premium valuations. Ask yourself, why are you the best team to solve this problem? Investors and buyers, when evaluating teams, try to assess the team's track record, skill sets, how complementary they are, along with their ability to build and scale products and a business. Startup or relevant experience. Investors often look to fund repeat founders as they believe that their prior experience makes them well suited to start a new venture. Cultural fit. Buyers also look and assess the team's capability and culture fit in being part of a larger organization and the team's ability to scale quickly. Growth trajectory. Growth is by far one of the most important drivers of valuations in tech companies. Depending on the stage that you are, if you're tripling revenue for the first 3 years, followed by doubling, you're going to get a premium on your valuation. Investors are often willing to overlook profitability during the early stages and the growth stages if you can maintain and demonstrate high gross margins in the business and also very, very high growth rates. Another factor that plays a big role in startup funding and valuations is competition and market maturity. First mover advantage might sound fabulous to a copycat business, but it can be terrifying to a startup that might take those first steps. If you have a new technology, you're trying to create a new market or a new category from scratch, that could be one example. In the case of the latter, you have to first convince investors and then convince the consumer or create the need for the product or service. On the flip side, entering a mature market that's crowded, that's a red ocean with established players, means a startup is another me too, and its potential for growth might be limited. So you have to prove why you are going to win and why you're going to take away market share from incumbents. Further, if comparables exist in a similar category or geography, investors are often use that as benchmarks to value the business. What valuations did those comparables raise money at? What do they trade at on the stock markets? Another factor that plays an important role is frequency of capital infusion in a particular company or category. This might be a sad reality, but when investors see a startup that's received funding multiple times in the past, their interest is further sparked. And that's how money follows money in the startup world. While the amount of funding raised by a startup can be a factor of the founding team's ability to pitch, to close a deal, and to get across the line, a startup's past funding is often the prime motivator for new funding to come in. Ask any founder. It's toughest to get the first early investors or early adopters to believe in your mission and vision of the company and offer you seed capital. Once the company has started off, proved itself, subsequent rounds of financing come in, and there's a buzz about the company in the investor fraternity, your business has a higher ability to then go out and raise further capital. One important factor to note here is that highest valuation, or the higher number that you can negotiate, is not always best for your business. Valuations may be high at first, but investor preferences may drive it down later. High valuations can also limit options and interest from investors who expect often a 10 times return or more on successful startup bets. Inexperienced founders may not be prepared for the rapid growth that comes with a large check. We have also seen that high valuations from private investors don't necessarily translate to the public market. As we have seen in some of the recent IPOs, private rounds sometimes tend to overvalue companies, and the public markets may not meet or give you those same rich valuations. So rather than considering the valuation alone, focus on finding the right partners, drill down on their experience in your niche, in your type of product, and the possibility of making further investments along your journey that will help you scale the company. I often like to use the example that it is a partnership or a long-term marriage, and the check that's first cut is just the beginning of that relationship, not the end. So don't always go for the highest valuation. Instead, find investors who can help you build a company. They can help you attract customers and other future prospective investors, employees, and stakeholders to your company. Hope you enjoyed this content. Please like and subscribe to our channel, and let us know if you have any comments or ideas for other videos that we can make that could be helpful to you. Thank you for watching.